Lam Research is a company that is revolutionizing the semiconductor industry, which has been booming over the past few years, with Nvidia leading this race. They specialize in the creation of the tiniest high-performance chips used by companies such as Nvidia, Intel, or Taiwanese Semiconductors. Now, even though they play such an important role in the current market, they are currently down by 21% over the past 6 months, and over the past year they are up by only 4% and are actually trading very near their 52-week low. And so today we will use our stock valuation spreadsheet where we will figure out whether Lam Research is set to grow in the near future. Now, as always, first we will go through the fundamental 9-pillar analysis and later calculate the intrinsic value of Lam using our 4 valuation models. Now, first of all, we have to plug in their ticker symbol, and as we can see, all the metrics show up automatically. Now, right away, we can see that Lam is a dividend company. They currently have a dividend yield of 1.25% with a dividend payout of $0.92 and a very low trailing free cash flow payout ratio of only 23.10%. And as I always say, the trailing free cash flow payout ratio is very important, especially for companies which operate in the technology sector and have to direct a lot of their free cash flow into innovation and overall developing their business. If we have a look to the right, we can also see that the analysts currently project the price of $96.05 within the next year, which is quite higher than the current trading price of the company. Now, jumping straight to the 9-pillar analysis, we can see that Lam gets a rating of 8 out of 9, which is a very decent rating, with only one pillar currently sitting in the red, and that being the 5-year P ratio to be below 22.5. Now for Lam, this is currently sitting at 22.99, which isn't bad at all. Now if we have a closer look at the P ratio, we can see that currently it's actually sitting at 23.91, which is a bit more expensive than the average company. We can also see that the P ratio has been growing at a rate of 12% yearly. So even though currently the company would be considered quite fairly valued compared to their earnings, the PE ratio is something I will have to keep my eye on. Now moving back to the 9-pillar analysis, we can also have a look at the price to free cash flow, which is a very similar metric to the PE ratio, except for earnings we have a look at the free cash flow of the company. And over the past 5 years, this is actually sitting at 15.08, which is in the range we like to see. But if we have a closer look, we can see that currently it's actually sitting at 22.94, and that as well has been increasing at quite a high rate. So again, something we have to keep our eyes on. Now, something I very much like about this company is the consecutive dividend growth. And if we have a closer look, we can see that it has been growing at a rate of 12.62% yearly over the past 5 years. We can see the very nice growth right here. And this very high growth, more than triple the average, certainly makes up for the below average dividend yield of the company. Now I want to explain why the dividend growth is so important. So if we take a look, we can see that in 2023, the dividend is almost twice as much the one in 2019. Say you were to invest $10,000 in 2019, which would yield you, for example, $100. Now in 2023, you have still invested only that $10,000, which will now yield you $200 every single year. Now in the next 5 years, the dividend will again grow by 100%. Which is 400% higher than the dividend payout you were getting a year ago. And this is how the dividend snowball effect works, because after the $400 you will be making $800, after that $1,600, after that $3,200, and so on and so on. So that's the dividend snowball effect kicking in, and that's why you want there to be consecutive dividend growth. So a company with a high dividend growth can make your yield on cost 20, 30, even 40%. Now moving back to the 9-pillar analysis, I also want to have a look at the growth of the company. So we can see that the revenue has been growing at about 11% yearly, free cash flow at about 30% yearly, and net income at about 16% yearly. So let's have a closer look at these 3 pillars. We can see that the revenue grew from 10 billion in 2019 to almost 15 billion in 2023. The net income grew from about 2.2 billion in 2019 to 3.8 billion in 2023, and the free cash flow grew from 1.9 billion in 2019 to 4.2 billion in 2023. We can also see that the free cash flow per share has been increasing very nicely over the past 5 years. Now, before we continue, I just want to say these spreadsheets are very useful to both beginner and advanced investors. Whenever you see a company on the internet that interests you, you can simply jump to these spreadsheets, plug in the company's ticker, figure out its intrinsic value, and go through the 9-pillar analysis and understand whether it is worth researching this company further to possibly add it to your portfolio, or whether the company is simply not worth your time. And currently we are running a Christmas discount. You can find the discount code in the description. It's a discount for 20%, and if these valuation spreadsheets interest you, you can pick them up right now. But let's get back to the valuation. So we can see that Lam's 5-year profit margin is sitting at 46.16%, which is well in the range we like to see, and they have decreasing shares outstanding at a rate of 2.51% yearly, which means that you as an investor will own a larger percentage of the company with years to come. And finally, their long-term liabilities over the 5-year free cash flow negative dividends is sitting at only 0.34, which ensures that they won't get into trouble with debt, as the free cash flow they generate can cover all of their long-term liabilities, and they've actually been decreasing their long-term liabilities at a rate of 1.61% yearly. So now we can finally get to calculating the intrinsic value of the company, first using the Grams formula revised. So based on the 9-pillar analysis and based on the research I did in the backend, I will predict a high earnings per share growth into the future of 18%, medium of 15%, and low of 10%. And averaging this out with the analyst projections, get a 5-year earnings growth estimate of 15.20% into the future. And combining this with all the other metrics, we will get an intrinsic value of $88.86, which is 15% higher than the current trading price. Now moving to the second valuation model, the discounted cash flow model, we take the free cash flow of the company over the past 5 years and calculate an average growth rate of 30.35%. Now again, based on this, I predict a high free cash flow growth of 27%, medium of 24%, and low of 22%, and this will give us a future growth rate of 24.3% yearly. Now moving to the multiples valuation, where we compare Lam to two of its competitors, ASML and Applied Materials. We average out these two companies' PE ratios, which we then multiply by the earnings per share of Lam to get an intrinsic value of $88.61. And moving to the final valuation model, the dividend discount model, where we take the dividend payouts over the past 5 years and figure out the average growth rate to be sitting at almost 15%. I then project a growth rate of 10% into the future and get an intrinsic value of $165.33. And I said this before, when a company such as Lam has consecutive high dividend growth, it really increases their value from the dividend perspective. And now moving to the final valuation, the ultimate valuation, where we average out the 4 valuation models and get an intrinsic value of $112.95, which is 47.90% higher than the current trading price of the company. And with a margin of safety of 30%, we get an acceptable buy price at $79.07. So overall, Lam is looking very decent. They currently seem to be quite undervalued, with high growth potential and high dividend growth, and I personally don't mind paying a bit of a premium for the company, as I do believe that they have massive headroom and will grow a lot in the next few years. And with that, thank you for watching, and please leave a like and subscribe, as it really helps me out.